Hello, good afternoon, everyone. Welcome back to another Ican SFM class. And we are still in chapter 1. And the topic is the introduction to the SFM. SFM is strategic financial management. We are still in the introductory part of it, which is the chapter 1. And our sub heading for today is going to be financial objective. The overview of this section include financial objective and corporate strategy, the primary corporate objectives, wealth maximization, maximizing profit, growth in earnings per share, measuring the achievement of financial objectives, financial objective, the conclusion part of it, other objectives. And the last one is the role of the financial manager, the three decisions the financial manager needs to make. So we take the number one of it, which is financial objectives and corporate strategy. Every organization exists for a purpose. Like if you watch our previous video, you hear where I say there is always an objective, there is always an aim. So every organization exists for a purpose. For example, an organization may exist to manufacture electronic equipment, manufacture chemicals, provide a profit, provide a transport service, or provide an education to children. There are so many, whatever the objective is. But at the end of the day, you are driving towards making of profit. Okay? Within this overall purpose, an organization should have a primary objective. The aim objective of a company might be to maximize the wealth of the company's owners' wealth, its equities to the shareholders. The main objective of a state-owned organization might be stated in terms of providing a certain standard of public services. That is the government section we are talking about now. The main objective of a charity, that is a charity organization like orphanage home and all those stuff, those organizations for the less privileged, NGOs and all those ones. So the main objective of a charity would be to fulfill its charitable purpose. For example, provide maximum aid or support for a particular group of people. It could be the disabled, the orphan, the less privileged, the displaced, like the refugees, just like that. So when the main objective of an organization is not a financial objective, there is always a financial constraint on its objectives, such as providing the highest quality of public services with the available finance. They have to manage whatever resources they have very well because they are not targeting to make profits. Rather, it's how to satisfy the public. Okay. The identification of a primary objective is a starting point for the formulation of a strategy to achieve that objective. The identification of a primary objective, I'm repeating this sentence, is a starting point for the formulation of a strategy to achieve that objective. The process can be shown as follows. Okay, here is an illustration here of a strategic process. With time, I have to upload this making of my video so that I can be making some write-up. Okay, so there is an illustration here. Is a step-by-step process and it's having 5 steps here. The step 1, you have to identify the corporate objective, usually a financial objective. That is the major one. Then the step 2, establish target for the financial objective. You have to make a target from time to time. This is the stage we will be. This is how it's going to be. This is how we are going to achieve it. Then step 3, develop business strategy for achieving the financial objective target. There must be a business strategy. After you You identify what you want, you establish the target, then you have to develop a strategy that you use to achieve these your plans. Convert strategies into action plans. Monitor performance. When you have already kickstart everything, the strategies are into actions already. You have to monitor your performance so that you will know whether you are progressing or not. There are some time when um strategies are in place and everybody feel reluctant. Before you know, everything can slash back to step zero, or losing the complete focus if they are not monitoring the process, monitoring performance to make sure that everything is going well, to make sure that at least the performance of today is better than yesterday, as program is actually going that way. Okay, this take us to another subheading that says the primary corporate objective. Primary, that is the major one. Okay, for companies, the primary corporate objective is often stated as maximizing the wealth of its owner, equity shareholders. On a normal note, anybody that wants to start up a business, the major target is they want to make profit. They want to make profit. So this means maximizing the market value of the company. Many of the financial management models covered later in this test, okay, okay, is a proposed course of action in terms of its impact on the value of the company. The objective is not just theoretically used in practice. Surveys has shown that most of chief executives view increasing the market value of the company, which they control, as their own responsibility. I think I said this in one of my videos before. Okay, the primary objective is directed to the benefit of single stakeholders, the group, the owners. In reality, the wealth maximization objective must be pursued within the boundaries of the need of other stakeholders. For example, cocaine smugglers or money laundering might lead to large positive cash flows for a company. But one of the company stakeholder, which is the government, prohibits these activities. You see? So corporate social responsibility. We now move to another subheading. It says corporate social responsibility. Okay? Corporate social responsibility is a term to describe the view that a company should pursue objectives that are in the interest of the stakeholder groups. I hope you know what a stakeholder. If you don't know, I'm going to make a video on stakeholders soon, so you will know. But on your own, you can check out what stakeholders are. Stakeholders are those people that are affected by the activities of the company: the owners, the workers, the community, the government, everything within the environment that it affects, the people. These are the stakeholders: the owner, the staff that are working, the community, the government of the place where they are, or where this company is operating. These are the stakeholders. Okay, other than stakeholders, such as employees and society as a whole, which is the public. This is discussed in more detail later in this chapter. That's why I say I'll make another video on that. So, wealth maximization. When I was reading the section overview, the third one was wealth maximization. That is where we are now. We are in the third one. Wealth maximization. The main corporate objective is the maximization of stakeholder wealth, and this is taken as maximizing the market value of the company. Stakeholder wealth is increased by dividend payment and a higher share profit. I hope you know dividend payment at the end of the business for the year, when they share the profits, what they give to the shareholders. This is their dividends. Okay. Corporate strategies are therefore desirable if they result in higher dividends, a higher share price, or both. when the dividend is not given out to the shareholders, they can use it to increase their share capital. So this will not give them a higher share price. There are practical problems with using these objectives. That is the negative side of it. Now, that is disadvantage. What should be the time period for setting target for wealth maximization? This is a problem they need to think about. How will wealth creation be measured, and how can targets be divided into targets for dividend payment and target for share price growth? This is management decision. They have to know what to do. Like, there are some companies for about 5 to 10 years or even more. I don't want to mention the name of any company, but it's in the finance section. One of these banks, for the past 15 years, they keep on issuing the letter to their shareholders. They never give them their dividend. They don't give them dividend. They just give them the report, and show them how much dividend they were supposed to have, but it has been used to increase their share capital. This is what they do for more than 15 years now. So it's management decision. Share prices are often affected by general stock market sentiment, and short-term increases or falls in a share price must be caused by investor attitudes rather than any real success or failing of the company itself. The objective of maximizing shareholder wealth is generally accepted as a sound basis for financial planning, but it is not practical in terms of actually setting financial performance target and measuring actual performance against the okay against the target. Other financial objectives might therefore be used instead, in the expectation that if these objectives are achieved, shareholders' wealth will be increased by an optimal amount. This increase this include: number one, maximizing profits and achieving growth in earning per share. Let me explain this: maximizing profit and achieving growth in earning per share. Maximizing profit. A company might express its main financial objective in terms of profit maximization, and targets can be set for profit growth over a strategic planning period. Like as I said earlier, there is a bank, which I don't want to call the name, for more than 15 years. They have never given a dividend to their shareholders. Okay, this could be management planning decision that for this period of time, we are not going to issue out the dividend. Rather, we'll be using it to increase their their share price for a certain period. Maybe with time when they have meet this target of maximizing their capital, their profits, business expansion, and the rest. After then, they may start issuing out the dividend to shareholders. Okay, so profit growth objective have the advantage of simplicity. When a company states that its aim is to increase profit by 20% per year for the next 3 years, like as I said before, it could be they have a target of a year. So this one is saying for the next 3 years. The intention is quite clear and easily understood by managers, investors, and others. How the investors understand this letter that they keep issuing to them, at least they can read the details there. They will know that, okay, our money is increasing. Even if they are not giving it to us, we know our money is here, we know our money is increasing. Okay, the main problem with an objective of maximizing profit is to decide the time period over which profit performance should be measured. Okay, so we have a short-term profit, and also so the short-term profit might be increased only by taking action that will have a harmful effect on profit in the long term. For example, a company might avoid replacing aging equipment in order to avoid higher depreciation and interest charges. Okay, or might avoid investing in new projects if they will make losses initially, regardless of how profitable they might be in the long term. This is management decision after they have looked at all the risk and everything involved and how it will work out for them. They have to make this decision. So it is often necessary to invest now to improve profit over the long-term innovation and taking business risk. Okay, are often essential for long-term success. However, long-term success is usually only achieved by making some sacrifices in the short term. In practice, managers often focus on short-term profitability and give insufficient thought to the long term. Is usual in most organizations like this. They prefer the short-term profit making than thinking about for something for so many years. The short-term outcome, that is majorly what they think. So in okay, so partly because the reason why they do this, the reason why they focus most times on the short term, okay, is partly because most of their remuneration might depend on meeting annual performance targets. Annual cash bonuses, for example, might be on depending on making a minimum amount of profit for the year. Partly because this is another reason again. Partly because managers often do not expect to remain in the same job for more than a few years. Therefore, short-term achievement might mean more to them than longer-term benefits after they have moved on to the different position or job. Okay. Another problem with an objective of profit maximization is that profit can be increased by raising and investing more capital. Okay. When share capital is increased, total profit might increase due to the bigger investment, but the profit per share might fall. This is why a company's financial objective might be expressed in terms of profit per share or growth in profit per share. So, under here now, achieving growth in earning per share. Okay, you say we are getting the details for shareholders' wealth, the ways it can be increased by an optimal amount. How can shareholders' wealth be increased by an optimal amount? So finish explaining maximizing profit. So now the number two I'm going to now, achieving growth in earning per share. Growth in the earning per share. The most common measure of profit per share is earning per share, or earning per share is something as EPS. A financial objective might be to increase the earning per share each year and possibly to grow earning per share by a target amount each year for the next few years. If there is growth in earning per share, there will be more profit to pay out in dividend per share, or there will be more retained profit to reinvest with the intention of increasing earnings per share even more in the future. Earning per share growth should therefore result in growth in shareholder wealth over the long term. Like the bank have used as an example, every year they keep giving their shareholders they keep on writing the letter to them. This is your share capital, this is your dividend. Okay, now your share capital has increased to this amount because we added the dividend of this year to it. So their wealth is increasing on the long run. However, there are some problems with using earning per share growth as a financial objective. So here are the disadvantages. It might be possible to increase earning per share through borrowing and debt capital. If a company needs more capital to expand its operations, it can raise the money by borrowing. Tax relief is available on the interest charges, and this reduces the effective cost of borrowing. Shareholders benefit from any growth in profit after interest, allowing for tax relief on the interest and earning per share increase. However, higher financial gearing, the ratio of debt capital to total capital, can expose shareholders to greater financial risk. As a consequence of higher gearing, the share price might fall even when any per share increases. Yeah, just consider the naira. Maybe mm, you got an investment of 50 million naira before. Then when you convert it to dollar, the way it used to be, and if you want to use that money to buy something, how what you can achieve with that amount, like 10 years back, coming to today now, definitely it's not going to get you the same thing. And when you change it to dollar, you know how much you have lost already. So on the long run, somehow it's at the negative side for the shareholders. Measuring the achievements of financial objective. This will be the next topic that we will look at. So thank you for listening. If you have any question, drop it at the comment section. If I read your comment, I will respond. Thank you, everyone. Good.